Hi, I'm Tom Elliot and welcome to another financial market update for Hodges Real Estate. Well, all sorts of things have been happening during the month of October. Now firstly, of course, the Reserve Bank of Australia, it meets on the first Tuesday of every month, and just days ago it finally decided to cut interest rates again. Interest rates, or at least the official cash rate, has now fallen from 3.5 down to 3.25%. Now I've been saying for some time I thought that official rates would probably bottom out around 3%, and I stand by this view. That means there's one more rate cut to come. It'll either come on Melbourne Cup Day, which is the first Tuesday in November, or as a Christmas present in early December. Of course, the big issue is not really the official rate of interest, because that is not the rate that you, I or anybody else get to go and borrow money. It's what the big commercial banks do with it. I think 3 of them passed on 20 of the 25 basis point rate cut, and one, I think Westpac, just passed on 18 basis points. Now, it's interesting because if you look at the market for fixed rate home loans at the moment, they've already been pricing in another 50 odd basis points of cuts. In fact, I had a look at some rates offered by a couple of the big banks recently, and if you're one of their preferred customers, you can now lock in 3, 4 and 5 year money for as little as 5.5%, and I think that is an excellent, excellent deal. The stock market, well, it's been doing its usual tricks. It's been relatively positive recently. It's trading up towards the 4,500 level at the moment. The reason for this is that in the last 30 days, both the US and European central banks have committed themselves to printing more money. Now, this is a policy that historically has proved disastrous for economies. One can look at Zimbabwe in the last decade, where they literally ran out of space on their banknotes to print zeros. The problem that central banks have in both the US and Europe is that people just aren't borrowing money, they're not spending money, and as a result, business conditions are pretty tough. The Australian dollar, in a normal world, the Australian dollar would be lower than what it is now. But again, if you go back to this money printing issue, because other countries and other currency unions, in the case of the EU, are trying to debase their currencies, that is to get them down by printing more money, it means that currencies like ours, where we're not actively trying to debase it, tend to go up, and that's what happens. So I think really we've all got to get used to a high Australian dollar. Although in the property sector, I will say that the strength of buying from overseas has probably dropped off a fair bit, because again, with that high dollar, it's more expensive for overseas buyers to get into Australian property. The retail sector is still very, very tough, and herein lies, I guess, some influence on the property market. People certainly aren't spending their money in the shops. You only have to look at the share prices of JB Hi-Fi, David Jones, Myer, Harvey Norman, etc. They're all doing it very, very tough. And whether or not this means are people prepared to buy houses at auction, I think the two things are linked. So, the outlook for the property market. The reality is the clearance rate is still stuck at around the 55–60% mark. Obviously, it varies enormously depending on which part of Melbourne you are looking at. Now, if I'm right and interest rates have got further to be cut, that should obviously prove a fillip to the residential real estate market. I guess the negatives, and there are a few of them, are these. Now, firstly, at the moment, people don't seem to want to borrow too much money. So even though money is becoming cheaper, they're not going to the local bank and saying, can I have a bigger mortgage? Secondly, we've got immense political uncertainty. Just the other day, we saw the Speaker of the House of Representatives, Peter Slipper, resign. A third issue, which I guess has to be taken into account, is that of unemployment. Now, the September unemployment data has just come out, and it shows that unemployment around Australia has increased from 5.1 to 5.4%, and that's something that both political leaders in the federal parliament should be concerned about. Finally, an issue that's come out, and it's more from the international front, the International Monetary Fund, which is one of the better respected bodies out there when it comes to economic forecasting. Just recently they have downgraded their outlook for the Australian economy. The downgrade says that instead of growing at 3.5% next year, our economy will only grow at 3%. If I had to make a prediction about things, I do think the Australian economy will be okay, resources boom or not. Anyway, that's the end of this financial market update for Hodges Real Estate. I'm Tom Elliot, and I look forward to your company again next month.